a very good evening. Welcome back to ET Now. You're watching The Money Show with me, Tanushka Sarkar, right here on ET Now. And this is the show where we'll talk about everything personal finance. And today we are putting the spotlight on one of the most important financial goals for every Indian family. That's planning for your child's education. Now, with education costs rising faster than regular inflation, the number one question viewers keep asking is, how do we prepare for it financially? To help us break this all down, we have with us today certified financial planner Nisreen Mamaji, the founder of Moneyworks Financial Services. We'll chat with her in just a bit, but before we get started, here's a quick programming note. Now, the beginning of every month often marks key financial activities, salary credits, bill payments, and planning expenses. But just as we plan for our expenses, it's equally important to plan for our investments as well. And to encourage this habit, SBI Mutual Fund, in collaboration with Times Network, is launching a nationwide investor awareness initiative, Bharat Nivesh, Behtar Nivesh, Behtar Kal. The objective of this initiative is to promote the habit of consistent investing among Indians, helping them secure their financial future. And as part of the campaign, we're observing 4th of every month as a monthly reminder to ensure that you start your mutual fund SIP or ensure that your existing SIP continues. So go on and set your reminder to consistently invest and stay committed to the goals for you and your financial well-being as well as your loved ones. Well, so let's get started then on this edition of the show. And we have with us, like I said, Nisreen. Always great to have you with us. Nisreen, education planning stresses out so many parents, and mutual funds are often recommended as the best solution. So let's dive right in. Now, let me start, with the basics. Tell us, why are mutual funds such an effective tool for planning a child's education? What makes them better than traditional options like FDs, PPF, or insurance plans?
Sure. Firstly, thank you for having me on the show, especially on such a sensitive topic, because, this is also related to our emotions, because we always plan to send our children, we aspire to have the best possible education for our children, either locally or internationally. So when you're planning for your child's education, you need an investment that can grow steadily and also keep up with rising costs. So when you ask me whether, the options are, say, fixed deposits or any fixed income product, that typically is not a very good, inflation-adjusted return provider. So you need a product that will also adjust for inflation and keep up with the rising education costs. Now, therefore, mutual funds fit very perfectly with this part of the goal, especially if you're invested in the equity mutual funds, or if your risk appetite doesn't allow 100% equity mutual funds, maybe a hybrid mutual fund, which will be a combination of equity and debt. So, as you get closer to the goal, at that time, you can move completely into a fixed income or a debt mutual fund. But during the planning stage, during the accumulation stage, if you are invested in an equity mutual fund, you'll at least keep up with the rising costs and with inflation. So as the child grows, over the term period, you can have a very good plan that will meet the rising costs of education as well. So the investment can stay aligned with your future planning, wherever you're planning for your child's education.
You've already answered most of it, but let's dive a little deeper into it. Parents know that they need to save, but they often don't know how much, where, and, how to start. So how should parents really structure their mutual fund plan for education? And how do they estimate future costs, pick the right funds, and decide how much to invest through SIPs?
So basically, we have to work backwards. So suppose your child is, say, 3 to 5 years old, and you have an aspiration that you want to put your child in a professional course, maybe in an international, destination. So whatever the current cost is, you have to figure that out. The cost of tuition, living, books, boarding, the entire cost package, you work that out right now. And then we kind of work backwards and say, okay, this is what your in 2040, this is what your cost will be, and what your SIP will be in order for you to achieve that. That's what, that's the value that we bring to the table. So it also has to match the affordability, right? Because, it could be a figure which might be beyond your capacity. So then in that case, you could also be advised to, to plan for an Indian education. So, if the international education is right now out of bounds, at least have a goal which is, slightly more achievable. Because during the 15 or 18-year tenure, your financial status can also change. So there are many variables in this. Now, SIPs in an equity or a hybrid mutual fund, will make a lot of sense if you have time on your side. So as a child will approach the actual age of admission, say if you're applying for undergraduate education, it's normally 18. And if you're applying for postgraduate education, because say in North America, the course is 4 years, for undergrad. And in England, it is 3 years. So it depends on where you are planning. If you're planning in India itself, it can be 3 years or 4 years, depending on the institute that you go for. So you apply, you know that your goal post is when the child is 18, and the next goal post can be your master's, which could be at age 21 or 22. Now, so, there are, because of the variables, if you haven't met your goals when the child is 18, you could also be advised to put all the corpus and your planning together for a postgraduate education. So as a child reaches that term, either 18 or 21 or 22, you will have to figure out what is possible and also plan your SIPs accordingly. So in this way, this is the simple guide that where the mutual fund strategy will be able to help you to reach your eventual goal. And obviously, you will have to keep a very strict review and plan every 2 to 3 years. Do the review to make sure that you are on track. Also, sometimes parents start out with 2 children, and then maybe a third comes on the way. So then, your budget gets divided between either 2 kids or 3 kids. So there are a lot of variables. The idea is to have a plan and start working towards it with a good mutual fund strategy.
Mutual fund strategy, especially if you're looking at overseas education in the long run. But
Right.
Nasreen, here's a very practical question. Like you were earlier pointing out, as children grow older and get closer to college, how should the
Right.
equity debt mix, how should that change? When should parents start shifting money into safer debt funds?
So typically, what happens is there are a lot of factors, in case you're applying for a foreign education, there's currency depreciation, there's indirect costs such as accommodation, living expenses, other related expenses. And sometimes there are country specific factors also. Like in Australia, the education inflation was 113% in 2020 and 21, and the overall economic conditions. If you're applying for India also, the general inflation rate is about, say, you can take an average of 10%, even for Indian education. So what happens is if your tenure is longer, like if you started planning when the child is 3 or 5 years old and you're planning, say, for an undergraduate education at age 18, you can start investing in an equity mutual fund or in a hybrid mutual fund, which is a combination of equity and debt if your risk tolerance is a little lower. But typically, if your tenure is high, you could take a very sort of a plan to invest in a 100% equity fund, because when the tenure is longer, the volatility is eased out. And say 1 year or 2 years before the actual admission date starts, and when you have to start making the withdrawals, you can at that time switch into a like into a debt fund, which is very safe and where that the volatility will not be affected. Your returns might be compromised in the last 1 or 2 years if you are in a fixed income or in a debt mutual fund, but at least you will know that the corpus that you have collected over the last 15 to 17 years will be safe. And then from there onwards, you can start paying off every 6 months or every year, depending on what the institute is, what their structure is. So that's typically the plan. For the longer term, you invest in equity. Towards the end, when you reach your goal post, you can switch over to a debt fund or again a hybrid mutual fund with very, very low equity allocation, because you don't want any volatility at that stage.
Don't want any volatility at that stage. That's the real plan. But things always don't go as we plan, and many families often struggle to keep their education savings intact because other expenses keep popping up. So, Nasreen, why is it important to create that separate education bucket rather than mixing it with general savings?
So that's the key point actually, because you'll have the children's maybe first is an undergraduate education, then you're planning for a postgraduate education, and you're also planning for their marriage, and then finally your retirement. So depending on the number of children you have, you'll have 1 child, 2 child, or maybe more, 2 children or maybe more. So you'll have these multiple, kind of buckets or pockets of investment that you have to start undertaking. Now, towards when you're reaching the goal, uh, most often what happens practically is that you're, borrowing from one bucket in order to pay for the bucket that is for the expense that has already arisen. So suppose you started in say 2025 and your own retirement is say in 2050 or 55. your first child's education goalpost hits at 2045. So at that time, you will be struggling and you will kind of just use whatever resources you have. So that's what you start doing, and that is the practical experience, because you have various investment options that you have started out with. But it's very important that if you have borrowed from, say, your retirement option, to make sure that at some stage you put that money back, because you don't want to actually land up in a position where you've compromised a very, very important goalpost of your own, which is retirement. Because at that stage, your children will be very busy doing whatever they have to do and leading their own lives, and they may not look back and actually sponsor that retirement. So be very careful that each bucket or each investment fund that you have created will be suitably planning for its own goal. And if you need to borrow from another one, you have suitably readjusted your plan so that your final retirement goal or the marriage goal that you have for your child is not compromised. Now, in these days, a lot of times, people are not spending too much on marriage, and they feel that education is actually much more important. And the marriage goal, they're not spending and keeping a lot of money, because ultimately, your income is that much, your expenses are fixed, and, your savings bucket and your investment amount will not change drastically year on year. So, maybe a 10% step up of SIP is possible, but beyond and above will lead to most families struggling. So, it's very important for you to prioritize what is the goal that is most important, and also to keep on adjusting your goals depending on what corpus you have reached. So say, and also your children's interests might change. Like you might feel that, I want my child to become a doctor. But at the end of so many years, your child might want to be a musician or an artist. Also, will have to take some professional courses for that, but maybe the fee structure is different. Maybe the institute that the child wants to go is different. So you have to, pay a very important role in reviewing this entire plan to make sure that, your goals are aligned to your child's goals and also to the financial path that you have taken up for yourself.
Right. Well, yes, absolutely. You're right. And thank you, Nasreen, for those insights. And the big message today, of course, is clear that start early, stay disciplined, and treat education planning as a non-negotiable financial goal. That's the word coming in. On that note, we'll slip into a very short break. After the break, we'll take all your specific queries that you've sent us with Nasreen. We'll be right back.